What's going on, guys? Welcome back to the channel. In today's video, we are taking a look at Google. We're going to look at the numbers, figure out what they're doing right, what they're doing wrong, and find out the intrinsic value of this company so you'll know if you're getting a good deal on this company. If you've watched some of my other videos, I've consistently said, hey, you know what? I think sub $100 is a good price for Google based off a 10-year analysis. What we're going to do, folks, though, is do a 7-year analysis. But before we jump into that, some exciting news is that Google's now partnered up with GM to reinvent their infotainment system. So they're axing Apple CarPlay, rework, well, I guess what it means for Android Auto to exist, and essentially make these infotainment systems in-house for GM. Google now has another stream of revenue, I'm assuming, based off the fact that they're now partnering with an auto manufacturer. On top of that, they're pretty much axing out their top competitor, being Apple. So if you have an iPhone and going forward, you want to, let's say you buy a GM vehicle, this might become a problem because now you really like the car, but now your phone can't connect to it. Now what? What do you do? Well, you might be just switching out the phone and going with something like this. This is a Google Pixel. But the more important things, folks, is this: the financials of this business. Over the last 5 years, Google has been a phenomenal business. Is they're scoring a 9 out of 10, which is a phenomenal score on the financial valuations of the software here, the stock spec software. 7-day free trial if you want to try it out. Follow the links in the description box below. So they're only getting a point knocked in one category, their price earnings ratio of 25.03. We want to find companies that have a price earnings ratio of 22.5 and lower. That would indicate to us that that is a more fair multiple to pay for those earnings. Anything higher is you're paying a premium, and most likely most companies can't justify that premium, especially a company such as this, which is $1.34 trillion market cap. Now, everything else is looking really good. It's pretty much solid all across the board. Current ratio of 2.38, return on equity average of 21.22%. So they can cover those liabilities. They have a high return on equity. Their EPS is growing. Their debt to equity is extremely low. Well, not really extremely low, but sitting at 42% is pretty solid, given the fact that means that they are also buying back shares. So they are leveraged more so in the equity of the business. That means instead of taking on debt, as well as of those shares that are used to being funding to fund the operations of the business, they are buying back those shares. So there must be some shares that are undervalued, because it doesn't make sense to use your free cash flow to buy shares that are overvalued. Makes sense, right? Along with that, their net income is up over the last 5 years. Free cash flow is up. The return on invested capital is sitting at 15%, which I like finding companies above 10%, and they're well above that, which is great to see. Along with the revenue growth sitting at 21% increase over the last 5 years. I like Google a lot. I think this all makes sense to me. Now, the only thing is, are you willing to forego and look over that price earnings ratio? I think so. 25, big deal. It's close enough to 22.5 anyways. So to me, this is almost a perfect company based off of those numbers here. Now, price earnings ratio on 12 months is 23. So you're pretty much almost there. And you can kind of see what's going on here, folks, is that this company over the last little while, last 2 years has been on a decline. Return on equity is just sitting above the 12 months, which is great to see. Profit margin is pretty much in that range of the 5-year average. They have an average free cash flow of $44.7 billion. Those are massive numbers. And currently sitting on $60 billion of free cash flow. Look at that. That is phenomenal. So numerically, Google is a strong company. And these are one of those companies I don't see going away. Especially now with TikTok pretty much on the way out. There's a lot of people just kind of... Governments are pretty much banning the app and trying to reduce exposure to it because they don't want it on American soil. And look, Google has obviously YouTube Shorts, which is pretty much their, I guess their IP. I don't know what's the right word, but they have YouTube Shorts, so obviously they're going to try to capitalize on that. And just YouTube in general is a revenue-making machine. They're the 2 top largest search engines in the world. This company's not going anywhere. That's the facts. However, what do we pay for this business, guys? So here in the price analysis section, I've put in some numbers that are reminiscent of the historic numbers that Google has shown us over the last 10 years. I've done a 7-year analysis, like I said, and I've used some conservative revenue growth numbers, 5, 7, and 9% over the next 7 years, along with keeping the profit margin and free cash flow margin in a similar ballpark of what they've shown over the last 10 years. along with obviously conservative price to free cash flow and price to earnings ratio. Desired return of 13%. I click calculate. It's going to run through those numbers. And we're going to find out what the current, what we should be paying for Google today. So let's see. The suspense is killing me. Come on. A lot of math. Boom. 104 is the current price. Average calculation comes out to be $93.89. So ultimately, folks, if you pay around $94 for this company today, you can essentially expect a 13% return. Now, here's the thing, folks. Here's the thing. I put revenue growth for 9% in my aggressive category. So basically, let's say over the next 7 years, it grows like how it grew this in the last year by 9% with a 22% profit margin. $119, pretty much $120 if you want to just call it that. You're essentially getting it almost at, it's essentially undervalued at that point. So that's being the fair value. So if you can expect it to do exactly what it did in the last year, this aggressive average makes the most amount of sense to you. However, I don't think so at all. I think probably it is somewhere between the conservative average and the moderate average. Those are the averages I like looking for. So if it's $70 here, $92 there, call it slap dead in the center and say $80 is what we should be paying for, or $94 if you really want that. However, the more you forecast this company out, obviously this number will grow a little bit larger, because now you're stretching out that analysis to cover a longer span of time. And just to show you what that looks like, 109 is the price point if I look at a 10-year analysis. And just to be completely transparent, folks, I have shares in Google. I actually paid $94 for this business. I paid $94 for those shares. So I essentially got it at the fair value from my 7-year analysis. Now, I was doing a 10-year analysis, and my other previous videos, I've always done 10-year analysis. So what do I think? My process is this. I think depending on your outlook and how you plan on holding the company, I don't think Google's going to be going away. I do think with this news with GM is exciting, but the main thing is that I didn't bring up is how much will AI affect their search engine? Because ChatGPT is ultimately a huge thing that's coming up. And it looks like it's fairly impressive that Microsoft might be able to nip at the heels of Google, and they're obviously working with developing Bard further and further. There's much more to keep in mind of how this company is going to perform. However, that's the importance of having a decent margin of safety, because if you're wrong, you don't lose as much. And that's what we're trying to do, folks. We're trying to control the downside risk, because the upside will take care of itself. If you enjoyed this video and you found it helpful, hit that like button, subscribe button, and make sure you share it with a friend that's looking to potentially up their investing game. And make sure you hit that bell notification to not miss a video from me ever again. Because listen, folks, we're all about value investing. We're all about making sure we're buying quality businesses at great prices. So I'll see you in the next one. Thank you so much for watching.